Hey everybody, I've decided that it is time for me to get back into my non-QM series here and talk more about these bank statement DSCR loans. With most lenders now developing some level of strategy on these non-QM types of loans, that's bank statement DSCR, asset-based for the most part, we're seeing a lot more misinformation out there because there are a lot of lenders who are very seasoned, been in this industry for a long time, who haven't necessarily gone down this rabbit hole and figured out exactly how to close these loans. So I want to make sure that all the information's out there ready for you, and I'm always happy to chat about it. But the number one question that I was always surprised that I have always gotten on these bank statement lending opportunities is I didn't think I could buy a house if I was self-employed. And the reason for that is most people are made to feel by the mortgage industry that they cannot qualify for a house if they own their own business. They just can't do it. They have to make enough money to either buy the house outright, settle for something less that is qualified by their adjusted gross and their tax returns, or they have to adjust their tax strategy to be able to purchase the kind of house that they and their family needs. And I'm here to tell you that that is not the case. Bank statement lending can open up that box quite a bit because conventional government-sponsored enterprise-backed loans, you have to fit into a tiny little box, right? You can't have a lot of write-offs. There are just a number of factors that are qualified differently for those types of loans, and it doesn't suit everybody. So if your tax strategy is complicated, if you have a great CPA, there's an alternative route that might sacrifice the rate by a quarter, 0.5%, but it'll put you into a house that you might not have qualified for otherwise. With bank statement lending, we can look at your 12 or 24 months of your business bank deposits or personal bank deposits. We can look at a CPA prepared profit and loss statement. We can look at 1099s. We can look at a number of different ways and angles to be able to qualify you, again, for the kind of house that you want to shop for, not just something that you can qualify based on what somebody else has told you. Most lenders are really well versed in conventional lending, and they know how to run those income calculators based on what Fannie Mae and Freddie Mac or Ginnie Mae have to say. And being turned down by somebody doesn't mean you don't qualify. It just means you've been disqualified by the wrong lender. And not to say that this is necessarily the right loan for everybody. You have to be in business for 2 years. You have to have good credit scores. These aren't the pre-2008 Nina, Cena types of loans. Like, we need to show certain information, the 24 months of or 12 months of bank statements. We have to show that you've been in business for at least 2 years. In some cases, maybe 12 months. We want to show that you have a CPA or a licensed tax preparer who can attest to your ownership percentage, the length of time you've been in business. But we don't have to look at the tax returns. We won't look at the tax returns. We're not going to qualify anything off of your adjusted gross. And I think that it puts a lot of self-employed borrowers into a better position. That way you can invest in real estate in ways that you really want to. You can see the returns through appreciation. You can see the returns through rental properties. And there are a lot of other ways to really consider homeownership in today's market. If you have questions about it, I want you to send me a message, look me up. I've been in the top 100 in non-QM lending for the last several years for all mortgage professionals across the country. So this is something I know very well. I'm happy to share everything I know with you and help you find the right strategy, not just now, but over the next 5, 10 years of home ownership.